Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. And with me today, I'm excited to have Stanford Wyatt from August Partners and Rational Research. Stanford, how's it going?
Good, Andrew. Thanks for having me on. I appreciate it.
Hey, no, it's great to have you on. Let me start the way I do every podcast, and that's by pitching you. And I'm just going to continue what I was telling you before we start recording. Rational Research is what I mainly know you from, and I know you run August Partners, which is a small partnership on the side, and we can certainly talk about that. But Rational Research, I've just really been enjoying it. You've been doing it for several months now, and the way I kind of describe it is once a week you put out what I call a macro piece, where it's looking at something macroeconomics from how one or two kind of micro firms are talking about it. So the example I was trying to think of was this week's was use sports betting data trends from New Jersey and New York City to get some insight into how sports betting is trending overall. And I think you also had some consumer luxury goods stuff from Tiffany, Louis Vuitton, and even an RV piece on Lazy Days results. So I've just really been enjoying it. And you get those macro pieces. Plus, I think you've done about 3 deep dive fundamental pieces so far, which we'll talk about 1 or 2 of those today. I read every issue and it's priced at free, which is, it's just the perfect price for me. So no, look, that pitch out the way. Stanford, maybe you could go a little bit into your background on how August Partners and Rational Research came around.
Yeah, well, I appreciate it. And thanks for the kind words. And I'm a big fan of your work as well, and listening to the podcast. And so I appreciate the invite. And yeah, as you mentioned, my day job is managing a partnership, an investment firm called August Partners Investment Management. And then, I started, Rational Research a few months back, as you mentioned. And, I guess through the framework of just kind of helping my investment process, for my partnership. And so, as you mentioned, the weekly piece, a lot of it's just looking for facts and kind of what, do they roll up to any bigger themes, bigger investment themes that might kind of influence my, my investment decision making. And then also just, kind of getting more involved in the FinTwit community and, seeing if there's anybody else out there that might kind of care about those specific companies or themes, and do they have any feedback? And then, occasionally, the individual stock thesis piece. I mean, writing's always been a big part of my investment process, and is helpful in clarifying my thinking. And so that's part of it. And then the other part is same idea of just trying to get more feedback, get in touch with other people that might have some insight on those particular companies. And so I'm hoping I can do more write-ups on individual companies in the coming months. And it's been fun. And then, so, and my background, so I started the partnership and the partnership in the investment firm about 2 years ago. Prior to that, I worked for a long short fund here in Seattle for over 10 years, doing fundamental research and building my network and my investment framework. So that's a little bit of my background.
Cool. And then August Partners, so that's your, as I call it, your day job.
Yep.
Most of your time's focused there. How how focused do you run it?
Pretty focused. It's the number of names, varies, but we'll say 10 to 15 long positions, and I can do short. So those will be smaller positions and maybe higher number of individual positions there. But yeah, pretty concentrated fund, and do a lot of deep fundamental analysis, just looking for opportunities that are mispriced, in the public market. So and there's a lot of reasons that companies could be mispriced, whether it's just liquidity or short-term concerns, or financials that don't really tell the whole story, that sort of thing. So my process is focused around looking for high quality businesses that may be mispriced for a particular reason. And then I also care a lot about the people involved. I mean, the insiders, what's their behavior. I think the behavioral aspect can be pretty predictive of what might happen in the future, and is not necessarily always always priced in. It's not the easiest thing for sell side to write about. And so I care a lot about, who the people are that are involved and kind of what their behaviors are. And then just looking for risk reward setups that are favorable.
Yeah, no, look, I think management is one of the things that's been ingrained in me the hardest over time. Like, there's only so many times you can invest in something that's trading at 20 cents on the dollar, only to watch management take 90 cents of that dollars and put it into their pockets, or just light it all on fire until you realize, like, oh my gosh, like, not everyone has to be Jeff Bezos or something, but if you're investing with the absolute worst, like, you'll get lucky every now and then, and they'll decide to sell, and that 20 cents becomes the dollar. But most of the time, they're going to find a way to make that dollar shrink into 5 cents or 10 cents, and you're actually not going to profit. Let me ask you, Rational Research, obviously it's an outgrowth of all the work you do at August Partners. The two write-ups that come to mind, and the two that I think we're going to talk about on the fundamental side, were the piece on Nordstrom, which I think will be our focus today, and maybe a little bit of the piece on Tile Shop. And both of those are kind of, old line retailers. We can call them at a high level view. So you run concentrated 10 to 15 position. How much of it is like in more older type value names, and how much of it is going to shift into more like, what's probably more popular today, the growthy tech stock names, or is it just a blend? How do you look at that?
Yeah, it's a blend, and I'm open-minded. I mean, I guess all things considered, I don't really, look at kind of growth versus value or that sort of thing. I mean, I think it's all kind of, ingrained or, intertwined. I mean, I'm happier to pay higher multiple for higher growth type companies. Again, it's kind of what can I find that's really mispriced? And I guess a lot of that really high growth kind of SaaS stuff that, that has great management, great, visionary founder type leaders, but a lot of that stuff seems to be pretty, fairly valued even if I extrapolate kind of growth trends continue for quite a while. And so, like I said, I'm open-minded, and then just looking for mispriced things. I guess that's kind of led me to a couple of these, as you said, old school, retailers that I've written about. And I've followed both those companies for quite a long time as well. But I guess one of the frameworks I've been thinking about recently is just kind of these epicenter type companies that were just right in the crosshairs of COVID, right? I mean, brick and mortar retail. And one of the things I was thinking about is, second quarter, end of first quarter, second quarter, kind of that's, if you survive that, you've probably got an enduring business on your hands, right? And I look at, Nordstrom, who was closed for half the days in the second quarter and actually generated positive free cash flow, which is pretty amazing. I mean, again, speaks to just kind of the nimbleness of the management taking action, and obviously you've got high insider ownership there, and a family that's owned the business for 100 plus years. They're incentivized to obviously do what's best to survive, right? I mean, they don't want to take existential risk when they have, $600 or $700 million or more, hopefully more if the stock goes up, but of equity value on the line there. And so, I guess that's kind of, I guess to summarize how I came to those kind of two companies is just looking through that framework of companies that have been able to adapt and will endure. And then when they come out on the backside of this, I mean, there's a lot less competition. They've probably learned a lot how to improve their digital business and that sort of thing. So.
And I don't want to go into Nordstrom too much yet, because I want to talk a little bit more about Rational Research, but let me dive into one of the points you made there. So you said, management's really incentivized to come to this. They own a lot of the stock. It's Nordstrom's family. I think, was it John Nordstrom, the founder, who founded in like 1900, 1901? Yep. They've been around for over 100 years. Yep. The family owns a third of the shares. They're very incentivized. And normally that's a great thing. But I also do worry, I think of like a newspaper family in the early 2000s where they owned a lot of the newspaper shares. And they said, you know what? The newspaper industry looks bleak right now, but we've been delivering print to your doors for over 100 years, and our family's done that. And we're going to double down. We're going to go buy all these newspapers at valuations. Or, a current example would be something like Dillard's, right? Dillard's, which is another old line department store. I think they barely had an online sales component to them until COVID started. And maybe you looked at that pre-COVID and said, oh, a lot of online shopping is at a loss. They don't really have competitive advantages. But, I look at them and I say, oh, maybe this is a family that's too wed to, this is the way our family's always done it. For Dillard's, I think all of the family members are like 80 years old and on the board. But, do you worry about that with Nordstrom's, or just in general, like the family control? Yes, they're economically aligned, but maybe they don't move as fast as they should because they just have an older way view of the world?
Yeah, I think so. I mean, that's definitely a concern, and I think they've invested a lot in their digital business over the years, and I guess I think they're smart. I mean, they're headquartered in Seattle, a couple blocks from Amazon, right? And I know
Yeah.
I'm sure they lose a ton of people to Amazon constantly, and so I don't think they have their head in their sands to realize kind of what's going on there, and the future of e-commerce and brick and mortar retailing and all that. But I guess a bigger concern for me is just that they have invested in e-commerce, and I think trying to bring their business into the future a little bit, and it just hasn't, they haven't grown as fast as,
Yep.
even if you look at last year in a kind of normalized year, I think their digital business grew 7%, right? And if you just use, Amazon's North American business as a proxy, grew 21% last year, right? So,
Yep.
I mean, it's just, they're kind of lagging. And then, even now in the recent quarters, you see a lot of these kind of, legacy brick and mortar retailers that have an online component that's grown, 100% or more. And, Nordstrom didn't come close to matching that. And probably a lot of that's apparel is not the best segment to be, probably would be one of the
Yep.
last to recover out of this thing. But I guess that to me is the bigger concern, is just that they might be a share loser for whatever reason, as opposed to, I don't think that they're kind of delusional with what's going on in the world with e-commerce and the shift to digital. I mean, if you look at last year, was digital was a third of their revenue, and in the second quarter was 60% of their revenue. So I mean, they're there. I mean, they have a good good offering, but
I agree.
I just don't know if are they losing share. I guess that's my biggest concern when I think about this as an investment.
No, I agree. Like, look, I think a lot of their buy online, pick up in store stuff, even before the crisis, I think was better than 99% of their competitors or something. I think they were doing stuff, but you do worry, like, and again, I want to ask one more thing on rational research, and then we'll dive into Nordstrom's. But
Sure.
like, they invested what, like $500 million into a New York City flagship store, and they started that investment in like 2016, and it just finished. Unfortunately, it opens like literally the day before the crisis or something, right? But still $500 million into a physical retail store, while like Lord and Taylor's going bankrupt around the corner from there. And you wonder, I get what they were saying with it, but were they a little too wedded to the vision of the Nordstroms in the center of Seattle versus what the future was when you invest that much money? I mean, $500 million is a lot of money to invest into a store. Yeah,
no, I agree with you. And I think that, by the time that all got wrapped up, maybe that was something they wish they hadn't have started. Maybe the world was looking different in 2014 or 15 or whenever they kind of started that project, right? And you have Macy's Herald Square, and you have Bloomingdale's and Saks Fifth Avenue, all these stores that have a big kind of Manhattan presence. And they've talked about New York being such a big market for them, and they get an e-commerce uplift from having, as you had noted, an e-commerce uplift from having that physical presence in New York City. And but yeah, it's hard to say if that's a 5-year lead time project. Maybe by the time they got down to the end, it was something they otherwise wouldn't have done. But I mean, they have 100. They closed 16 stores in this last quarter. They have 100 kind of Class A mall locations with their full line stores. I mean, I guess I just don't. It's not overstored, right? In the context of thousands of retail locations, right? I mean, they have pretty good with their full line stores, pretty good locations that we'll see. I mean, if they are exposed to the mall, but I just don't think that they're in a terrible spot with their real estate. But yeah, I mean, to your point, management, maybe that wasn't the best decision. We'll see how it all plays out, and maybe they do lose some competitors there in Manhattan that might help market share over time, but we'll see.
Cool. No, I agree with you there, and we'll come back to Nordstrom's in 1 second. I just want to ask you one last thing on rational research. One of the things I like about it, as I said, was you do these weekly, I call them the macro micro looks, right? Where you use what one or two companies are saying to look at something micro. And, I think if you were doing this in 2019, I don't think I would have learned as much from it, right? But I think one of the interesting things in the 2020 COVID environment, I mean, it's like nothing anyone has ever seen before. I don't think many of us imagined what it would be like.
Yeah.
Is there anything in particular that these kind of micro macro dives have taught you, or anything that was kind of unexpected when you've done them?
No, again, it's kind of part of my investment process just to look at really, what are the facts. I think, Wall Street gets so hung up on, beat by a penny, miss by a penny, or, you know, forgetting about the fundamentals and panic over, case counts or whatever it might be. Right. So I think just doing this weekly and kind of, if I'm invested in Nordstrom as an example, what are the other brick and mortar retailers actually saying, right? I mean, what are the comps? What are the trends that they're talking about? And so it's helpful just to keep, for me, just to keep revisiting the actual facts and trends that companies are talking about. So just doing this, again, it helps me to stay focused on the facts. And then maybe if you get enough of these tidbits, you can kind of roll them up to an overall theme in an industry or sector that's happening. But yeah, I guess, to your point, this year has been pretty wild in terms of just the share shifts and everything else that have gone on. So I think constantly kind of looking at these reports is pretty eye-opening. And I think a lot of times it goes, a little bit overlooked by maybe general population. So it can lead to some interesting opportunities.
Yep. Perfect. Okay. Well, that out the way, let's dive a little bit further into Nordstrom. I'm sure most people know Nordstrom. They think of it and they think of the department store. If I told anyone, or if you told anyone, hey, I'm looking to invest into Nordstrom's, the first thing I think they would say is physical retail is dead. And they probably would have said this in 2019. And then especially in 2020, they would have said, hey, everything's going online. Amazon's going to eat everything. So I guess when you're looking to buy Nordstrom's, what's the first thing that gives you comfort that, physical retail is not dead?
I guess there's quite a few. I mean, you can look at results of peers. You can look at, results here. I mean, there's, the category leaders coming out of this are seeing sales increase, both, at brick and mortar stores and online. And then, combination of the two can be pretty powerful. So I think that's a piece of it. I think you can look at any of the e-commerce players, Amazon obviously buying Whole Foods and opening up their Go stores and everything else, gives some credence to having a physical presence and the value of that. And there's a lot of other examples if you think about Warby Parker and Bonobos and Blue Nile and a lot of the kind of legacy online players that started opening stores because it's cheaper cost of advertising, right? When the Google clicks for diamond ring, skyrocket in value, get more impressions, having a spot in the mall for a lower cost than you do, paying Google. So I think, so yeah, I mean, combination of things, but I think people always want the experience. I think there's certain categories that, maybe lend themselves better to shopping in person, as opposed to buying commodity books or, computers online. Maybe makes more sense. But yeah, I mean, I'm not arguing that the U.S., is probably overstored, over retailed. I think that, that's probably true. And I think a lot of the weaker hands may have been washed out here in the last 6 months or so. But yeah, I think it makes sense from a operational perspective. And I think consumers are always going to want the experience of shopping in person to some extent.
So I think what you just made was the famous clicks to bricks argument, right? Where, I think even Nordstrom's has said it, like if we open a physical store somewhere, online sales go up 20% because you get you get the advertising of people driving by the storefront. It becomes easier for people to do returns and exchanges. It boosts the brand. So that's the clicks to bricks argument. So let's say I concede that, which I think most people have conceded. Warby Parker rolled out stores, Bonobos rolled out stores. Like there's a reason all these digital only places rolled out stores. Untucked is another one I think of. But so I'm going to concede that point. But I think the counter to that would be, okay, but Nordstrom's is a department store, right? They are not a online brand. They're not Whole Foods where people are going once a week to get food. They are a department store. And if I look at department stores, Sears, JCPenney, Lord & Taylor, Neiman Marcus, like bankrupt. And that's just a start. Macy's, even before the pandemic, I think they were going to close something like 15% of their stores or something, 125 stores. Everyone was trying to close down department stores. So why is why is Nordstrom's different? Why are they a winner here?
I guess I kind of would frame that just in the context of downside protection, right? I mean, you look at this company's endured for 120 years, as you said. The family owns 30% of it. They're not taking existential risk with the balance sheet. They've got a lot of the debt is pretty far termed out. They have been investing in, improving their technology in the future. And then, like I was saying earlier, I think, 100 stores in the Class A mall locations is probably one of the, better positioned department stores. And, if the Class A malls continue to do okay, I think that's a decent position to be in. And then 250 rack locations, again, not a huge number in the big context of TJ Maxx has 3,000 stores in the US. Mm-hmm. So not a huge physical footprint. And then again, the company has endured, and so some of the other companies you mentioned that have filed bankruptcy recently maybe didn't have the same kind of alignment or history there. So I think that's part of it. And I think just, again, I mean, the price begs the question, right? I mean, it's not like this thing is priced to be the next Lululemon or anything, right? I mean, it's almost priced like people don't think it's going to survive. So I guess all those things kind of roll up to maybe answer your question, maybe not.
Yeah, no, look, I think one of the things I like about it, and not to like interpret your words for you, but Nordstrom, all of their full price stores, department stores, almost exclusively are Class A malls, catering to kind of a higher end person. And they do a lot more of the in-person stuff. One thing they always hit on, which I think people dismiss, but their alteration business is huge. And people come in, just get alterations. And they've got the personal shopper for a lot of it, who's really giving you kind of a personal touch to that thing. And when I think about something like, Sears is probably the most famous department store bankruptcy. And a lot of that was driven by Eddie Lampert. I think he saw the future really clearly and he executed really poorly if you go look back at his things. But Sears was also a ton of Class C malls, right? Like they were so poorly positioned for the future. And if you think, ignoring at some point, hopefully COVID goes away and kind of you can resume in-person experience and stuff. But if you think that's the future, I do think there's something about Nordstrom specifically that positions them well. And then just playing off that point, if I said on the back of COVID, a year from now, 18 months from now, things start normalizing, do you think there's a chance that Nordstrom's is like kind of reporting super normal profits for a while because the competitive landscape is just so wiped out? People who would normally go to the mall and shop at JCPenney on one end and Nordstrom on the other, the JCPenney's gone, so they just go and they spend 50% extra at Nordstrom. Does that make sense?
Yeah, no, it does make sense. And I think, that's definitely one of the upsides of this investment thesis. And I was going to mention too, I mean, Nordstrom does have 13 million, loyalty members too, which to your point about why would they be one to survive? I mean, that's not a huge number, but when you sign up for a private label credit card with Nordstrom, right, they've got a lot of data. And as a customer, you're kind of making a commitment that you want to be a loyal customer. So I think they do have kind of that built-in customer base too, which is helpful just in weathering this time and, looking a year or two out. But yeah, to your point, when you look at Lord & Taylor and Barney's and Neiman Marcus and, Saks and JCPenney's closing stores and Macy's closing stores. And Nordstrom has closed 16 full line stores in the last couple of months out of, now down to 100. It should be a lot less competitive and then they've cut a lot of costs, right? I mean, I think they come into the year planning to cut 200 to 250 million of costs and add it, and then cut an extra 250 million. So you're up to 500 million of kind of cash cost cuts this year. When you consider that the EBITDA estimate for next year is $1 billion, right? I mean, they basically cut half their way to the EBITDA estimate for next year. And so I think, yeah, to your point, I mean, if sales are anywhere near kind of normal, which they could be helped by a lot of these competitive closures, and you pair that with a pretty significant cost cuts and then lapping all the CapEx that they've been spending on New York City store and everything else, there could be super normal profits for a period. So, who knows exactly what that looks like, but I think there's definitely some upside there.
Let's talk valuation for a second. And it's one of the things I don't like to do the most on the podcast, because, when I say, oh, this trades for, I think you could earn $5 per share next year and it trades for 100. So it's at 20 times. Like, that doesn't really flow well when people are listening. Like, this is mainly audio. Even if you're YouTube, you can see our face, but it's not like there are numbers flashing up and down. Right. I think it's important, like, how Nordstrom's has been shelled out. Like, how cheap is Nordstrom's if we're looking at this on a normalized basis?
Yeah, I mean, there's there's a lot of ways you can look at it, and I think again, I think you can kind of throw 2020 out as just as kind of a crazy year. But if you consider they did $1.5 billion of EBITDA last year, and if you look at the operating cash flow, they've done over $1 billion of operating cash flow, I think, for 11 years in a row. They did $1.2 billion last year. So, and then I think CapEx now, if you look at kind of what they're talking about CapEx, they'd cut 30% of CapEx this year, but you're probably at, $450 million of CapEx on a go forward basis. I mean, if you ask yourself, can they get back to, $1 billion of operating cash flow and, or more, and CapEx of $450 million, maybe now interest expense is kind of $150 million, but that's kind of baseline. And then, what could kind of the upside be if sales materialize in some way? But, yeah, I mean, if I look at, so EBITDA in 2019 was 1.4 billion, and now people are kind of expecting 2021 is just over $1 billion. So, you're down pretty significantly versus a normalized 2019. And then, again, with the cost cuts in there of 500 million, can they do $1 billion of EBITDA at some point in the future? I mean, it's not going to be this year. Maybe it's next year.Maybe it's a year beyond that. But that definitely seems reasonable. And then, kind of the low multiple that this company's historically traded has been like 4.5, 5 times EBITDA. So right there, you're kind of at a high teens stock price if you get just a kind of historically low valuation on pretty depressed estimates, right? And so I guess, again, the question comes back, do they survive? I think with $1 billion of cash on the balance sheet and the debt that's pretty far termed out in the future, I think they do. I think they'll survive. And then you just look at kind of what are these kind of very base case or pessimistic case scenarios, and even those lead to pretty decent upside from where the stock is now. And then, if you just think back, they can get back to a 2019 type of EBITDA at some point and put a 5 or 6 times EBITDA multiple on it, then you get to pretty substantial upside. And you can do the same thing with, operating cash flow minus CapEx. You can get to pretty high cash flow yield. So,
yeah. So, and I'm just going to summarize. So I think one of the simpler ways is I look at this and say, at today's price of, call it $13 per share, the enterprise value is approaching $5 billion. In 2019, they did about 1.4 billion of EBITDA. So you're paying like 3.5 times EBITDA if you ever think they can get to 2019 levels. You can slice it up a bunch of different ways. Earnings per share was about $3.20 in 2019. So you're paying, 4 times EPS if they ever do the 2019 levels. So what we're basically saying is, hey, like, if you ever think they can get close to where they were last year, which I hope we've started to build the case and we can build it further that they will, this is a 4 times earning stock. And, 4 times earning stocks, radio stations are 4 times earning stocks, something with 100 years of durable brand and what we think is a lot of physical touch points. And yes, not everything going in their favor, but a lot of the stuff in the world that's changing actually is kind of plays into how they've traditionally been valued. I think that's kind of how you look at this thing. Is that right?
Yeah, definitely. And I mean, one other interesting point is, management gave guidance for 2020
Yeah.
on March 3rd, which was basically, right before the world fell apart, but which kind of gives you
They
an
were
interesting,
liars within 4 days.
yeah, exactly. But gives you interesting insight into kind of what they thought was possible
Yeah.
for 2020. I guess had 2020 turned out to be more normalized. They were talking about 325 to 350 in earnings, and then I think they guided a free cash flow like 750 million, after capex, and now keep in mind their capex has been cut 30%. So if those are kind of reasonable ideas of what a normalized year could look like, then the stock is really cheap. And again, management's incentive comp, I think, was at least for last year, in the most recent proxy, was based on even higher numbers than that. I think it was 1.5 billion EBITDA or something similar to that. So anyway, I think there's a lot of different ways you can kind of look at it. And if they get anywhere close to kind of this guidance or the historical numbers, then the stock is really cheap.
Yeah, and then the other last thing I'll add here is, we talked earlier about these generational investments they made. They sunk over $500 million, they said, into opening a New York City store that opened October 2019, right? So we've been seeing 2019 earnings levels where, if we had been talking in December, we would have said 2019 earnings is a trial level, because we put these massive generational investments, and it wasn't just NYC. NYC was the headliners, but there were other things. We put these massive generational investments that, opening a new store takes about 2 years to really start to pay off and to build up the foot traffic. You would have been looking to 2022 as kind of, hey, this is the year our New York City investments and all these other things say. So we're saying they get back to 2019. And I think that could, in some ways, says they're getting back to a much lower level, just because that New York City store is starting to pay off. Does that make sense, or do you disagree with any of that?
Yeah, no, that makes sense. And I know you'd written about it a little bit, but they were expecting some uplift in sales in the New York area from opening the store, and then obviously just the reduced capex after getting that done. So I mean, to your point, kind of definitely peak capex last year, right? So you're coming down big time off of that, and then hopefully an uplift in sales in a normalized environment.
And then another piece, just moving into a little bit more in depth in Nordstrom. When I say Nordstrom, I think most people think Nordstrom, the full price department store. But another piece that I'm really interested in is Nordstrom Rack, their off price business. I think when you mentioned TJ Maxx earlier, TJ Maxx is in several thousand stores. Nordstrom Rack is not even in 300 stores yet. But I think that is a growing piece of the business that's really attractive, really interesting. Could you talk a little bit more about the Nordstrom Rack off-price business and how you look at that?
Yeah, it's a third of their sales overall, and they don't break out the margin profile of Rack versus full line, but that segment overall, it seems you can just look at the success that TJ Maxx and Ross have had in the U.S., and it seems like that's kind of the big or one of the big retail tailwinds or sectors that's done really well. And I think brick and mortar stores, people appreciate that treasure hunt experience and the value that comes with it. And so, I think that there's a lot of opportunity there. I mean, again, I guess, as I was saying earlier, my bigger concern is that even on 250 stores compared to TJ Maxx with 3,000 or Ross with 1,600 or whatever, I mean, they just haven't, Nordstrom Rack hasn't grown as fast as kind of the really kind of well-operated off-price retailers. I mean, you put Burlington in that category as well. But I think there's definitely opportunity. There's some synergy there with clearing out merchandise from the full line stores, and then there's a press release Nordstrom had out last week, but they've been working at fulfilling online orders from Rack.com from the Rack stores, and then if you order something from Nordstrom.com, you can pick it up at the Rack. And so I think they're just getting better at kind of using that retail footprint to fulfill orders, to use that inventory more effectively, and then to offer the customer more convenience. So I think that's all positive. And Rack TJ Maxx and Ross really have never, they don't have a big online business, right? So that might be an opportunity, I think, for the Rack to kind of exploit their strengths and and be kind of the leader in off-price online. They have the Outlook, which is kind of a flash sale website, which also you can, return to the rack, which is convenient. And so I think there's some opportunities there. Hopefully they can capitalize on and kind of take a lead in that off-price online business.
Yeah, and you mentioned the synergies between the rack can take excess inventory from full price Nordstrom and kind of help liquidate that, right? So that puts
Yep.
you in a better inventory, better positions managing all that and stuff. And I think one of the things that attracted me to Nordstrom's is this some of the parts argument, right? Like full price gets a different multiple than off price, and there's some real estate in there, and then they own some other stuff. But when you do the whole sum of the parts, I think it comes out, it's a company trading at 4 times EBITDA, right? Like it's not hard to get a sum of the parts higher than this. But one of the things I think the company would argue, and you started to dive into it, is there's synergy between having these two pieces together. When somebody shops at Racks and joins the Nordstrom's club, they are more likely to go buy at full price Nordstrom, or you can buy online, pick up in store, all that type of stuff. How much do you think like the sum of the parts understates the opportunity because of those synergies there, whether it's on the cost side or the customer side or just any piece of that?
Yeah, that's a good question. I think, the sum of parts is always tough because I don't think they'd be able to split the two up. I don't think they could monetize rack and get some fair value because I just don't think, the Nordstrom name, being separated would work. I doubt, the family would go for that. But, I think, again, you hit it and you're right up. I mean, 1 times revenue on a pretty kind of normalized level is, for the rack is worth more than the company as a whole right now. And, TJ Maxx and Ross trade well above 1 times revenue. So I think that's, that's an argument that makes sense. And just again, for looking at the downside protection and and then, there's some real estate value, as Nordstrom owns, I think 33 of their full line locations, or owns a land under the building. And, again, hard to know how much equity value might be in that real estate and if they could ever monetize it. But, again, just in terms of downside protection, hopefully that provides a little bit more. And, so, some of the parts, I guess I don't really, that's not how I would, I kind of value the company as a whole and the earnings and cash flow potential, as a whole business. But I do think it's an interesting exercise, especially when you think about just the downside protections of if things really went haywire, would they just try and, sell some real estate, sell the rack if they're open to it, maybe. But yeah, it's a good exercise.
No, I don't disagree. What about, do you think, I believe what they say is somebody who shops at Rack ends up spending 4 times the amount of money, or like is 4 times as more likely to shop at Nordstrom full price. Mm-hmm. Some of that is because you shop at Rack and you can get enrolled in the Nordstrom's club and all that sort of stuff. Do you think that Rack actually benefits the full price division as much as they talk about?
That's a tough one. I mean, I guess all you can do is take them at face value, because you never really know. And as somebody that starts shopping at the Rack really move up to start shopping at the full line store. I mean, maybe that's possible. Maybe once you're just ingrained in the loyalty program, and if you sign up for the credit card, you're just more incentivized to shop across all their brands, and that's positive. And I think they did that in Investor Day a couple years back, and they have a couple slides in their slide deck that's on that point, just of how much more valuable that customer is that shops across multiple channels. But I think hopefully they can, if they make the whole ecosystem more convenient, right, with this buy online, pick up in store, and fulfilling, using inventory across the channels to fulfill online orders, and you can return at any location, you can pick up at any location. I mean, maybe for that customer that's kind of agnostic to full price versus online, you just make their life a lot easier, a lot more convenient, and hopefully there is more synergy and more synergies coming as they get better at kind of fulfilling from all these different channels, and and then doing the pickup in store and all that. So I think that's, it's an opportunity. Hopefully it's one that they they can see more benefit from here in the next 3, 6, 12 months as they improve their systems.
Yeah, the reason I just wonder about that synergy is like, I do think the future is like weirder bundles, like Amazon. Who would have ever thought combining Amazon, which is like a retail business, with Amazon Video, which is a Netflix competitor? Like, you wouldn't really think of those two as natural complements to a bundle, but it does make sense when you're bringing down the cost of kind of Prime membership to get people in that Prime thing where they're going to spend 4 times more. And when I look at Nordstrom with Nordstrom Rack, like if there is actually that synergy, and I think you mentioned earlier, like, Amazon bought Whole Foods, maybe somebody ends up, an online player buys Nordstrom. If you are seeing signs of a Nordstrom Rack customer results in synergies for Nordstrom, you could apply that to buy Nordstrom, and there might be synergy to a whole host of like weird online things, like just one random one I haven't even thought about, but Nordstrom and Spotify, like Spotify buys Nordstrom, and then they have like, they can ship out merch and use in person, and it reduces the bundle. But I don't know, but you could see some type of weird synergy like that, if that makes sense.
Yeah, anything's possible in this day and age, and I agree with you. I think there could be some companies you never would have considered as potential acquirers for Nordstrom, and I think again, I think the real estate is interesting if somebody wanted some good Class A locations, and I think the vendor relationships are something else that may be kind of undervalued by Wall Street. When last year Nike pulled off of Amazon, 1P, and you can read the Birkenstock. That Birkenstock CEO went nuts on Amazon a couple years ago because there was too many fakes being put up, on Amazon. Amazon didn't do anything about it. So I think, again, Nordstrom with a 100-year history of treating their customers well, treating their vendors well, and treating the product well as far as how it's presented. They have good relationships with Nike and Birkenstock and a lot of these key vendor partners that, again, if somebody were to acquire the company, there's probably a lot of these intangibles that come along with it that maybe you wouldn't have access to some of these high quality brands right off the bat, if that's something that you wanted.
Yeah. Or as you said, like those relationships in the retail space, like we did a podcast on Shopify a couple of weeks back, and you could say like, hey, if Shopify bought them, is that the most natural fit? Maybe not, but I could start talking you into, hey, there's synergies in Shopify can use all their storefronts for pickup and returns across the entire business, right? Yeah. So that gets them some really interesting warehouse space that they might not have had before. Yeah. And it gets them the relationships with brands where they can go to all of their people and say, hey, we've got this relationship with Nike. Maybe we're a preferred brand. We can offer you discounted things on Nike goods to build through your storefront or something. I don't know, but yeah, I could see how like something with this good of a brand name, this good of storefronts, how there are stranger synergies with different acquirers than we would have ever thought. Maybe that sounds crazy, but as you said, Whole Foods and Amazon seemed crazy until Amazon went and bought Whole Foods.
Yeah, no, it's true. And I think, again, with 150 square foot full line stores, I mean, could you do some interesting, kind of pop-up shops and have have the Shopify partners kind of set up for 3 months in there and seasonally rotate in and out. I mean, there could be a lot of interesting stuff to do like that. So I'm with you.
Exactly. What about we mentioned there's two online components to Nordstrom. Is it Haughty Look or Hot Look? How do you spell
Outlook?
Outlook?
Yeah, Outlook.
And Nordstrom brought Trunk Club. These are both acquisitions. At the time Nordstrom did the acquisitions, these were much hotter. These were very hot spaces, and I think through maybe definitely a little bit of mismanagement and a little bit of these spaces were extremely competitive. They have not worked out, but there is value there, and I do think there is a future there. Can you talk about like kind of the smaller online pieces in Nordstrom's, how you look at that and how you see those going forward?
Yeah, again, they don't give a lot of detail in terms of what the revenue are. I can't remember. I think they paid $350 million for Trunk Club, a number of years ago, and Outlook when the flash sale space was really hot. And again, I don't think any value in the stock price is ascribed to either of those two brands, but I think it's it still is. The press release I mentioned last week where they're talking about you can order on Outlook and return it to a rack location or a full line location, stuff like that, where they're still, ingraining into just the convenience factor of what the customer can do, because most flash sale sites that are still around probably don't have that convenience element to them, or just the backing of Nordstrom, knowing you're getting kind of high quality merchandise. So I think that's all positive. And then at this point, maybe they can just figure out how to continue to leverage it within their overall ecosystem, because I think there's still a demand for it, and it's probably a better, again, if they can leverage their platform just to make those two brands stronger than competitors. I think that's a win, but I'm definitely not factoring that kind of upside into my overall thesis.
The one that really interests me is Trunk Club, and I'll let you dive into it a little bit. But the reason I'm so interested is I look at Stitch Fix, which I believe when they bought out Trunk Club, it was like Trunk Club and Stitch Fix were kind of number 1 and 2 at the time, or maybe Stitch Fix was kind of just concerned. But I think when I do Google searches, I still get a lot of hits on like Trunk Club versus Stitch Fix, which is the better one, and all this type of stuff. And I think Stitch Fix is a better business, stronger, bigger than Trunk Club at this point. But Stitch Fix, I'm just looking at my screen, is valued at $3.5 billion, and all of Nordstrom's is valued at like $5 billion. And Trunk Club has some value, and I do think there are synergies between Trunk Club and Nordstrom's, and there's optionality there. So, like, how do you Trunk Club? Could you talk to me about Nordstrom's owned it for over 5 years now? I think they've reimagined it a few times, and they've started integration into their stores. How do you look at that integration? What are they trying to do there?
Yeah, that's a good question. I probably don't have as much insight there as maybe you do, but again, you can look at Stitch Fix and their growth. I mean, it's hard to know kind of what the value is for Nordstrom, since they don't really break out Trunk Club separately, and to kind of be able to value it on par with what Stitch Fix is doing. But again, Stitch Fix tells you there is appetite for that kind of offering, and again, with Nordstrom having customer relationships and brand relationships, and a convenience factor with the storefronts, you think there should be some advantage there for Nordstrom relative to Stitch Fix. But again, the question is kind of how do you realize the value out of that? How do you get Wall Street to appreciate kind of an asset that may have some value, and maybe at some point they do break it out or give more color around kind of the revenue or earnings potential, just to maybe get people to value it, assuming there is some momentum there.
Yeah, I just think they've got 13 million Nordstrom's Club members. You get a lot of data with that membership, and you've got the Trunk Club, and it seems like that is the basis for a really powerful potential offering where Stitch Fix whole thing is you like blue shirts by this brand, they can use that to trigger here's all the other things we're going to start sending you a subscription product. It seems like Trunk Club's got a lot of that data already there, both through Trunk Club and their members, and through, hey, Stanford shops and buys this shirt. Here's 10 other guys who shop and buy this shirt. Here's 10 other things that those people buy. It seems they've got the basis of a really powerful recommendation engine behind that. And obviously that's not a subscription business, which is what Trunk Club and Stitch Fix are trying to do. But you could see the parallels and how maybe Trunk Club could even have advantages over Stitch Fix. Though I suppose that also comes down to a little bit of a execution and everything. Let's see, anything else on Nordstrom that you're really excited about that you think we should be talking about here?
I think we hit on a lot of it. I guess, the digital piece of the business, I guess that's a big opportunity going forward. And we'll see, if 60% of their sales were digital last quarter, I'd love to see them kind of execute and hopefully get up to kind of more industry type growth rates there. I think they've definitely invested in it. And, again, the buy online, pick up in store has done well. As I'd mentioned, it's interesting, the Bed Bath & Beyond CEO worked at Nordstrom until 2009, and, took over Bed Bath & Beyond a couple of years ago, and they just reported their first, positive same store sales in 4 or 5 years. The buy online, pick up in store is doing really well. And, so hopefully there's some learnings there that, he joined the Bed Bath & Beyond CEO joined the Nordstrom board in April. So hopefully, again, with, the digital and the buy online, pick up in store doing well, hopefully the execution there gets better. The other point I would make is just on kind of the setup here of moving, they moved the anniversary sale from the second quarter into the third quarter, which is a pretty big event every year. So I think naturally depressed the sales in the second quarter and pushed them into the third quarter. So you should be set up for, a better third quarter than second quarter. And bearing in mind, they still generated, positive free cash flow in the second quarter despite that. So August, the anniversary sale went into August. They were at a conference, mid-September, saying it was the best sell-through they've ever had. So that's positive. I think, you definitely, margins should be good. Inventory levels should be clean. I don't know how much inventory they had going into that anniversary sale, but to say it's the best sell-through ever, again, in 100 years, or I don't know how long they've been doing the sale, but I think that's a good sign. And then, again, looking at just some of the competitors, some of the data points that people have been talking about, I think, September and so far in October have been pretty positive for most other retailers. I would say there's one data point that stood out to me, which was, the Buckle. I don't think anybody follows that company anymore, but they have 460 stores and they report their sales monthly, and their same store sales were up 23% in September. And that's, mainly physical locations, 460 stores, mainly in the mall. I think 40% private label, 60% branded stuff. So that's a huge month. And I don't think anybody's really talking about it. And even I think August was up, 2% or something similar. And so, but you talk like, Capri and some of these vendors, Crocs and some other vendors that sell to Nordstrom have talked about improving sales. And, Tiffany last week had good commentary despite tourism being tough. And so, I think there's a lot of reasons to think the third quarter could be okay. And then, fourth quarter we'll see, and maybe get more into normalized environment next year if there is a vaccine. But yeah, it seems like, maybe top line is okay. And it's definitely not priced like things are okay. I mean, it's priced like things are terrible, but a decent top line paired with some cost cuts on the bottom line. And I think the setup's interesting. And then the other thing we didn't talk about is just the change in management compensation, right? I mean, management kind of had an incentive to kind of kitchen sink the last quarter because they traded the restricted stock for options that priced 2 days after last earnings call. So they had an incentive to, maybe not say as much positive on the last quarterly earnings call, but, takeaway there's a whole management team based now. And I think their exercise price is close to $15. So that's even above, where the stock is now. And,
hey, Stanford, I think you're cutting in and out here a little bit. See, yeah, we kind of lost volume.
Oh, okay.
There we go.
Okay. Can you hear me?
Yep, I can hear you.
Okay. Yeah. So I was just saying that, that's an interesting tell for management to change their compensation that way to get a little bit more equity upside.
Yeah, I think my main man, Mike from Non-Gap, and he was our third or fourth podcast. Everyone can listen to that. I think he was the first one who identified that. I believe it's called bullet dodging, where our stock's at 20. We think earnings are going to be awful. We set our options to price after we report the awful earnings, so that we get a really low stock price and the stock shoots up. No, I agree. I want to go back to what you said about the Buckle. Obviously that's N of one, but I haven't heard anyone mention that, which is, I think that's all physical retail is where their sales are from. I don't believe that.
Yeah, it's definitely most of it. I'm not sure if they have a much of online presence, but yeah, it's mainly physical.
But I'm with, Tiffany's, I followed that one pretty closely. And I mean, their earnings, like New York City's basically shut down, and New York City's a pretty good piece of their earnings, and their same store sales were like way up year over year, not month over month, like year over year. That's a pretty good sign. And obviously all of these are a little bit different than Nordstrom's, but I do, tell me if I'm wrong. We'll wrap Nordstrom on this. When I look at Nordstrom's, what I see is something that's very cheap. And I think the moment you start getting like the COVID clear signs, I think that's, maybe it's next month, maybe it's a year from now, but I think that's when the stock really responds. And I see a great management team that's, the capital allocation, I think, will really benefit the stock. We haven't even talked about that, but I think that'll really benefit the stock when trends kind of get clear. That's how I look at it. Do you think that's a decent way to put it?
No, I'm with you. I think, it's definitely, good management that's aligned with, with the minority shareholders and high insider ownership, and a great brand that's treated their customers right for 100 years and has endured that and has great, brand relationships. And, I think that's all positive. And then, you come out of this with a lot less competition, as a lot of their, competitors have closed stores, and not only department stores, but specialty retailers and everything else. And so, I think Nordstrom survives. They have a loyal customer base, and, a cost base that's much lower than it was last year, and potential for big, earnings upside.
Just one thing on the good management, and then we'll go to Tile Shop. One thing I have been thinking about is management tried to take this company, I'll say private twice, right? 2 or 3 years ago, they tried to buy out the whole company for $50 per share. About a year ago, they tried to not buy it out, but increase their ownership stake from about a third of shares to 50% of shares. They tried to get the board's approval. They were going to do that in the low to mid 30s, I think. They eventually dropped that. And then just last month or 2 months ago, they saw that their Q2 earnings were probably going to be poor, and they restructured their restricted stock to, as we talked about, to bullet dodge and get this and get stock options priced at a low price. So the last thing I want to ask you about is this management team, and I agree, I think they've been pretty good stewards. They've been interested in increasing value. But when I look at those three things, it actually speaks more to a management team and a family that's interested in kind of creating value for themselves, maybe the minority shareholders. How do you think about that? Or do you think I'm just kind of like overreading into kind of idiosyncratic things?
Yeah, that could be right. I guess hard to say, but if you look at their compensation, right? I mean, they have an ROIC hurdle that they have to meet, and then it's basically all based off of EBIT. So management is I think most incentivized on EBIT, which if they grow their EBIT, that's going to benefit all shareholders, right? And so that's one thing. And then taking it private, I don't know. I mean, maybe I don't know. That's hard to say. I think most shareholders would have been happy if they would have taken it private at $50 looking back, and again in the 30s. But I don't know. They've always paid a dividend. They bought the share back, bought shares back pretty consistently, and so maybe they're more looking out for themselves. But it does seem like they do kind of concern themselves with minority shareholders as well. So we'll see. But I think and just to kind of piggyback on what you're saying earlier, I mean, there's a bunch of stuff. I mean, I'd love to see an insider buy stock, of board member or insider actually just at these prices, step up and buy some stock. I think that'd be a big tell and nice catalyst. And maybe there's something going on behind the scenes. They can't do it, but they also mentioned they're doing an analyst day on the last call. I don't know when that is. I don't think it's on the schedule, but if they're going to host an investor day in the next couple of months, I think that's an opportunity there to maybe give more transparency around some of the things you were talking about earlier. And that's usually a sign they have at least something positive to talk about if they're going to do an investor day. And then, I mean, you have, if you get a vaccine, people feel more comfortable going out to shop, and then they have more reasons to buy apparel and buy some of these categories that Nordstrom sells, right? I mean, if you're going out to dinner more and going back to work a little bit more, then maybe you do need some new clothes and sort of some pent up demand there. So we'll see. I think there's a lot of stuff that could happen that would be positive, and they could even just reinstate the dividend, or buy shares back, or pay down some debt, whatever.
That's one of the things I like. I think they've been pretty clear. Capital allocation on pause, but when things return, they're going to go back to their old capital allocation, which I think it's like a third of the cash flow is dividend out, and then most of the rest is returned through share repurchase. And if you think they're getting back to $1 billion in EBITDA, and they're going to dividend out a third of the earnings after the capex and interest and all that, and buy back 2/3 at these levels, like, oh my God, I'm getting all my money back in several years. So that's interesting. Let's move on to Tile Shop. Spend 5 minutes there. I call this FinTwit's favorite microcap retailer. I think I put on Twitter, we were going to talk about Nordstrom's a $5 billion retailer and Tile Shop a $100 million retailer, and all the questions were on Tile Shop. So I'm somewhat familiar with it, but maybe just 2 seconds. What is Tile Shop? Why is FinTwit so bullish on the Tile Shop?
Yeah, it's a good question. I didn't realize it was FinTwit's favorite company, but that's interesting. But yeah, history is, it's been around since 1985, started by Bob Rucker, who was the founder, and it went public in 2012, and it was kind of a Wall Street, darling when it went public, and kind of unique retail format, and they sell hard flooring and that was it. And then there was a big short report, and I covered this company pretty closely back then, but there was a short report about some insider relationships. The CEO's brother-in-law was getting kickbacks from a tile vendor and just a bunch of crazy stuff, and then the execution was poor, and stock just got crushed, and it was kind of left for dead. Some management turnover and not great execution. And like I said, I had followed it, and I just I wasn't that close to it. And then I saw, last month, B. Riley, which is a company I follow closely.
Yep, same here.
But they filed a 13D, and I think initially bought, over 5%, and then they filed a couple 13, D amendments since then, and are up to 8% ownership. And so that piqued my interest, just because I, wonder what they were seeing. And then obviously just from following all the kind of home related, Home Depot and Lowe's and home improvement companies and home retailers, furnishings, all those companies are doing really well. I mean, it seems like housing's got the obvious tailwinds of people wanting more space and, get out of the cities where you're taking public transportation and elevators and all that stuff. So anyway, I knew housing was good. So I looked into it, and this is another one where same kind of scenario as Nordstrom, where second quarter, probably the worst possible quarter. Sales are down 25%, but they still generated $8 million of EBITDA and like 17 million of free cash flow. So I like that if you go through that stress test and you prove that, the management team was able to act nimbly and still generate cash in the worst possible quarter. And then looking forward, as you look at kind of existing home sales and everything else, their key metrics, and then what these other retailers are saying, you'd think that third quarter should be substantially better than the second quarter. And then, even annualizing a depressed, EBITDA level from second quarter, the stock's really cheap, especially compared to Floor and Decor, Lumber Liquidators, or some of the other publicly traded comps. And then, there was a crazy event last year. I don't know if you want to go into it, but they proactively delisted at the end of, I think it was October 2019. The board and management decided to delist, stop the share buyback, stop the dividend. Stock got crushed. It was down, in the ones. And then the two big holders who are on the board, they bought as aggressively as they could from like the day after that until maybe it was 4 or 5 weeks. They were buying aggressively, both increased their ownership quite a bit. And then a shareholder lawsuit was filed, which prevented them from continuing to buy. But just an interesting dynamic that they obviously saw the value there and wanted to own a lot more, which, as I look back on that, that's a pretty good sign. And then, fast forward, that shareholder lawsuit was just settled, actually a couple of days ago, but that's positive. That's out of the way. Those insiders are prevented from buying stock in the open market, I think, for 3 years. So they don't have the same incentive to try and, crush the stock again, so they could add to their holdings. And then some of the court documents show that they were just trying to fix the business up so they could sell it. Again, it's a good business with 140 stores that have a unique concept and in the right place with the right tailwinds. You got a lot of insider ownership. The two board members own 30% between the two of them, and then that founder who's no longer on the board, but he owns 10%. B. Riley now owns 8%. I mean, B. Riley is, I think, a pretty strategic investor. So you've got a lot of insider ownership and a cheap stock with good tailwinds.
And correct me. So I know the chairman, Peter Kamen, who's got a long history with microcap value investors.
Yeah.
The court docs, as you said, hey, look, he took this private with the goal, and he admitted this in court, right? Like with the goal of, we're going to spruce this up and sell it a year or 2, 3 down the line or something. When I say, hey, we're going to spruce this up and sell it a year, 2, 3 down the line, today the share price is $3.40 per share. What does this look like in a sale?
That's a good question. I think, it depends. Floor and Decor trades at 25 times EBITDA, right? So I mean, if you bought this company for 10 times EBITDA, 12 times EBITDA, there's quite a lot of synergies there. And you take out, public company costs on a small company and some other synergies. I mean, Tile Shop put in a ERP system at the beginning of 2019, which kind of led to some hiccups, I think, with the retail experience. And so maybe there's some synergies there with a bigger company that could just improve the systems. I mean, who knows what this might be worth to some. Maybe you could buy some EBITDA on the cheap. You could buy a decent brand and some retail know-how, some vendor relationships, or just private equity doesn't make sense just to buy some cash flow. Hard to say. There's probably a lot of potential outcomes there.
You mentioned B. Riley, who I follow quite closely as well. You mentioned them coming in here and you called them a strategic investor. So, I do think they have the potential to be a strategic investor, but the B. Riley, it's FBR Riley. They are an investment bank, trading shop, research firm, all that type of stuff. In what ways do you think they could be a strategic investor? Yeah,
got it. Sorry. And that's what I forgot to mention on your list of potential acquirers there. I mean, B. Riley's worked with the FRG franchise group, who's acquired Vitamin Shop and Sears Outlet and some other kind of retailers that may look to franchise those locations. And so I guess that could be another potential acquirer that would make sense. And B. Riley's worked closely with those guys, so it's interesting to see B. Riley take that stake. But yeah, I mean, Bryant Riley, who's the CEO of B. Riley, is on the board of another company that does works mainly with home builders doing flooring and cabinets, and then also does a lot of countertops for remodel and that sort of thing. So I think he's got pretty good insights into into what's going on with home improvement. So that's interesting. And then B. Riley as a bank and on the sell side covers housing and a lot of the vendors, and so they could pick up coverage at Tile Shop, or again could have some insights there which are interesting. So that there's that aspect, and then there's also just the downside protection that comes with now B. Riley. I think the Tile Shop balance sheet's in pretty good shape, but should they need to raise capital or do anything else, hopefully B. Riley would be a good partner to help on that front. Just again, a little bit more downside protection if they need to raise capital. So I think those are some ways that B. Riley's strategic.
Perfect. Well, hey, Stanford, I want to be cognizant of your time. You're the first person we've got to cover two ideas on one podcast. So nice. Might have been a little bit more to talk Tile Shop. But look, this has been a ton of fun. I'm going to be sure, I said at the beginning, I've really enjoyed Rational Research. I hope everybody signs up and gives it a chance. It's been a really value add subscription for me. The price is free, so it's tough not to be value add on that. But this has been great. And, I hope a year from now we have you on and we're talking about Nordstrom's returning to 2019 earnings level, Tile Shop maybe getting sold, and we'll just have a new idea to talk about.
I appreciate it. Thanks, Andrew. I appreciate you having me on, and it was fun.
Have a good one, man.
You too. Thank you.